Welcome back to the Daily Crypto Roundup. We've got a fast-moving session today and a slate of stories that really set the tone heading into next week. Bitcoin slipped back under that $100,000 mark after a wave of liquidations. Wall Street is sending mixed signals, as US regulators begin drawing the sharpest lines we've seen in years. Japan is hinting at tightening its ultra-loose policy, which would hit global liquidity in a big way. OpenBank is expanding its digital asset services and signaling something deeper about the European market. And then at the end of the episode, we're going right into the one story everyone is talking about: the approval of the first US spot XRP ETF. We'll dig into why that matters, who benefits, who loses, and why analysts are calling it one of the biggest turning points for altcoins in years. Stick around for that. It's the anchor story, and it's worth hearing all of it. Before we get started, if you're listening on Spotify or Apple, take 2 seconds, scroll up, hit follow on the show, and tap the 5-star rating. It helps the podcast get pushed out to more listeners, and it means you never miss an update when the big moves hit the market. Let's get straight into the numbers, because today's session tells the story of a market caught between confidence and caution. Bitcoin trades at around $98,111 after failing once again to reclaim that psychological barrier. Ethereum is holding better than some expected at $3,228. BNB sits around the $922 mark. Solana has cooled to $145 after a strong run during the week. XRP is at $2.34, steady as traders wait for the impact of the new ETF listing. Cardano trades around 52 cents, Dogecoin at 16 cents, Avalanche around $16, Tron at 29 cents, and Polkadot at $2.83. A relatively mixed set of numbers, but all telling you that sentiment today is cautious. Now let's talk about why Bitcoin slipped. Because this wasn't a natural slow drift, it was a sudden flush. More than $500 million in leveraged positions were liquidated across exchanges in the last 24 hours, and most of it came from overconfident long positions that had built up during the quieter part of the week. And it's always the same pattern. Low volatility creates a sense of safety. Traders start adding leverage to squeeze out a little extra upside, and then one sharp candle hits a psychological level, in this case, the 100,000 mark, and the cascade begins. Once those liquidations start, the exchanges sell automatically into the market, pushing price lower, which triggers more stops, which triggers more liquidations, and the whole thing becomes mechanical. There's another side to this, though. Miner pressure has quietly been building in the background. Miner revenues have been squeezed as difficulty climbs and operational costs rise. A few major miners have been selling into the market more aggressively than usual, and while that doesn't cause a crash on its own, it absolutely adds weight when the market's already leaning the wrong way. One analyst put it perfectly this morning: miner sell pressure is the silent volatility generator. Is Bitcoin in trouble here? Not really. It's dipped below 100,000 several times recently, and each time buyers have stepped in. But what this does highlight is that the market is still in that fragile phase where leverage can build up under the surface without anyone noticing until it's too late. It's also why going into next week, analysts are more focused on liquidity conditions than price charts. Which brings us to our second major story: the shift happening across US regulation and the completely divided reaction coming out of Wall Street today. Some analysts are calling this the most constructive environment for crypto since Bitcoin was created. Others are calling it a short-term risk event that could cap upside for months. And strangely, both of those views can be right. Earlier today, one of the major US banking research teams published a note saying the alignment between lawmakers on stablecoin regulation, clearer custody requirements, and a unified classification framework could unlock institutional participation at a scale not previously possible. That's a big statement, especially from a traditionally conservative research desk. They're framing the US regulatory shift as a 2025 version of what banking reforms were for equities after the financial crisis. Painful at first, but ultimately the foundation for the biggest bull markets. A quick word from our sponsors, then we will be right back. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
Okay, let's get back to it. On the other side of the aisle, several macro desks warned that this same tightening could slow down speculation, reduce liquidity, and force exchanges and service providers into a compliance adjustment period. That means short-term pressure, fewer wild swings, and a more rigid environment for the kind of retail-driven surges we've seen repeatedly this cycle. So which side is right? The honest answer is probably both. Long-term, clearer rules bring in bigger players, safer infrastructure, and more predictable flows. Short-term, the uncertainty and the cost of adapting to those rules creates friction. One strategist summed it up by saying, "Crypto is about to get safer and slower before it gets bigger." This is why next week matters, because if the regulatory tone continues aligning, the market may do something we're not used to. Adjust calmly, rather than explosively. And calm isn't always exciting, but it is the gateway to long-term institutional capital. Now, to understand how all of this connects globally, we need to look at Japan. And Japan's story today is surprisingly important. Earlier this morning, updated financial data showed that several Japanese firms posted larger than expected quarterly losses. Usually, that's a regional story. But the quote that got everyone's attention came from a Bank of Japan advisor who hinted that the era of ultra-loose monetary policy may need to end sooner than expected. If the Bank of Japan tightens, even slightly, global liquidity feels it instantly. Japan has been a massive liquidity provider for years. Its low interest rate environment has supported everything from tech stocks to emerging markets to, yes, crypto. When Japan tightens, the yen strengthens, risk assets cool, and Asian trading volume often dips. This morning, one analyst said, "Bitcoin is now reacting to yen strength as directly as it does to the dollar. That wasn't the case 2 years ago." But to give you the balanced picture, not everyone agrees that Japan is actually going to tighten meaningfully. Some analysts think Japan is simply jawboning the currency higher without intending to do anything dramatic. If they maintain their dovish stance, then Asian liquidity could actually become a tailwind into next week. So between the US tightening structurally and Japan potentially tightening economically, we're watching two major liquidity centers shifting in opposite directions. And Bitcoin is stuck in the middle trying to find a direction. Now let's bring in OpenBank, because their announcement today ties directly into this broader pattern. OpenBank revealed new digital asset service expansions in key European markets, adding custody and trading support through a regulated framework. This is not a flashy headline at first glance, but it matters, because it signals that European financial institutions are quietly scaling their crypto services, while the US debates regulatory clarity and Japan considers tightening. Europe might not be the most exciting region for crypto right now, but it could end up being one of the most stable. OpenBank's move adds another regulated on-ramp for retail and institutional investors who want exposure without navigating unregulated exchanges. And the timing, right as the US sorts out its framework and Japan considers tightening, is interesting. Europe could quietly become the predictable middle ground. And that brings us to the part everyone has been waiting to hear. Why the XRP ETF finally arriving hasn't sent the price into the stratosphere. And the answer is actually very simple. Hype always runs ahead of inflows. Traders spend weeks buying the rumor, front-running the approval, and then when the product finally launches, the actual inflows on day one are almost always slower than the imagination of retail investors. That's exactly what we saw with Bitcoin's ETF and even Ethereum's. Huge anticipation, but inflows build gradually, not explosively. And the second reason is just as important. Institutions don't FOMO. They allocate. They wait for liquidity levels. They wait for spreads to tighten. They wait for the product to settle into a predictable trading range. That means the first week of an ETF is rarely the fireworks moment. It's the months that follow that determine whether it becomes a major asset or just another ticker. And finally, Part of XRP's demand profile is tied to utility rather than pure speculation. Utility-driven assets grow slower but more sustainably because corporations, treasury desks, and payment networks don't rush to buy on day one. They integrate the product into their strategy over time, so the approval isn't the ending. It's the beginning of a multi-month repricing process. So, no, the price hasn't gone vertical this week. But the door that needed to open has opened. And once an asset has a spot product in the US, it tends to get revalued not based on hype, but on how much real capital starts flowing in. And that's what we'll be tracking next week, because that's where this story gets interesting. And that's where we'll wrap for today. A market caught between two regulatory worlds, global liquidity sending mixed signals, institutions in Europe quietly expanding, and XRP stepping into a brand new era with the first US spot ETF. Hit follow if you haven't already, drop a 5-star rating if you're enjoying the analysis, and we'll see you tomorrow for the next round of market coverage. And as always, we will see you at the top.